Welcome back guys to a new video. It's Simo here. So today I wanted to give you a proper institutional grade breakdown of what's actually happening here, what the numbers are telling us, and whether this pullback is a trap or an opportunity. SoFi stock tested a crucial support today, and I am expecting the worst, to be honest. The overall situation didn't get solved yet. I will start my research breakdown with 5 major issues. First one is short seller allegations. A major short seller report from Muddy Waters Research alleged deceptive accounting practices and hidden debt. While SoFi strongly rejected the claims, it created an overhang of uncertainty. Second, no interest rate cut expectations. SoFi's stock previously relied on an environment of lower interest rates. With expectations shifting to a prolonged higher for longer rate environment, the credit-sensitive lending environment is less favorable. Third, technology platform slowdown. Despite explosive top-line growth, investors were spooked by a significant drop in the technology platform, the Galileo segment revenue tied to the departure of a major client. Fourth, shift to lending versus fee income. Analysts and investors have expressed concern that the company's rapid growth has been increasingly driven by its consumer lending portfolio rather than its capital-light fee-based services. And fifth, elevated valuation. Even after pulling back considerably, the stock still trades at a premium multiple compared to traditional banks, requiring flawless execution across all segments to justify its pricing. To understand those issues well, it's essential to understand the macro backdrop, and it matters enormously. We are in a difficult environment. The 30-year US Treasury yield has pushed above 5.18%, the highest level in nearly 19 years. Inflation came in at 3.8% in April, which has essentially killed any near-term hope of rate cuts from the Federal Reserve. The Fed is holding steady at 350 to 375 on the benchmark rate, and there is now serious talk not of cuts, but of potential hikes before year-end. The S&P 500 and Nasdaq have been under consistent pressure as rising yields compress valuations across the board, particularly in high-growth technology and fintech names. On top of that, geopolitical tensions around Iran continue to keep oil prices elevated, and the lingering effects of last year's Moody's downgrade of US sovereign debt from AAA to AA1 have added another layer of anxiety to the fixed income markets. So when you look at a high-growth digital bank trading at 30+ times earnings and wonder why it sold off 53%, well, this is the environment it's operating in. Higher rates, tighter financial conditions, and a market that is punishing any stock that doesn't deliver perfect execution. Now let me bring you up to speed on the latest headlines around this company, because there has been a lot of noise and you need to separate the signal from the noise. In March of this year, Muddy Waters Research published what they called a scathing short seller report. They labeled the firm a financial engineering treadmill and alleged that management had inflated 2025 adjusted EBITDA by approximately 90% through aggressive accounting practices. Specifically, they challenged the fair value loan accounting methodology, questioned the classification of a $312 million JP Morgan loan sale, and raised concerns about off-balance sheet structures that they claimed disguised borrowings as revenue. That report hit the stock hard. Management responded immediately and firmly, calling the allegations inaccurate and misleading. They emphasized their status as a highly regulated bank holding entity overseen by the Federal Reserve, the OCC, and the SEC, and they stated that all financial disclosures are in strict conformity with US GAAP. They even said they would explore legal action against Muddy Waters. And what did CEO Anthony Noto do? He went into the open market and bought $500,000 worth of stock with his own money right after the report dropped. That's a tell. When a CEO is putting personal capital on the line while short sellers are attacking the company, that's a signal worth paying attention to. Then in April, the company delivered a strong set of first quarter results, but Wall Street's reaction was mixed. Several major firms, including Truist, Citigroup, UBS, TD Cowen, and Goldman Sachs, cut their price targets. Truist, for example, moved to $17 from $20 while maintaining a hold rating. The consensus remains a lukewarm hold with an average target around $22. And just recently, the firm announced the acquisition of Primary Bid, a UK-based fintech focused on directed share program technology. The goal is to give members direct access to primary market offerings like IPOs, which would deepen the investing ecosystem considerably. So that's the backdrop. Now let's get into the actual financial performance because this is where things get interesting. The first quarter of 2026, reported on April 29th, was objectively the strongest quarter in this company's history. Adjusted net revenue came in at $1.1 billion, up 41% year over year. Net income hit $167 million, marking the 10th consecutive profitable quarter. Adjusted EBITDA reached $340 million, up 62%. Earnings per share came in at 12 cents, and the member base grew by 1.1 million in just 90 days, bringing the total to 14.7 million members, a 35% increase from the prior year. Those are exceptional numbers. But the consolidated view only tells part of the story. You have to look at each segment individually because the dynamics underneath are very different. Let's start with the lending business, which remains the profit engine. This segment posted adjusted net revenue of $629 million, up 53% year over year. The contribution margin was 61%, producing $382 million in contribution profit. Loan originations hit a record $12.2 billion in the quarter, with $8.3 billion in personal loans, $2.6 billion in student loans, and $1.2 billion in home loans. Now, the natural concern when you see origination volumes ramping this aggressively is credit quality. Is the firm loosening standards to juice growth? The data says no. The average personal loan borrower has a weighted average FICO score of 745 and a weighted average income of $154,000. This is not subprime lending. This is lending to high-income professionals with excellent credit profiles. And management has been very explicit about where they're taking this segment strategically. They want to reduce balance sheet intensity over time by increasingly selling and securitizing loans rather than holding them. The transition to a more originate-to-distribute model generates fee income from origination and servicing while offloading the credit risk. If they execute on this, it fundamentally changes the risk profile of the entire enterprise. Now moving to the financial services segment, which is the growth and engagement layer, revenue came in at $428 million, up 41%. Non-interest income surged 55%, while net interest income grew 31%, driven primarily by the explosive growth in deposits. Total deposits reached $40.2 billion, growing by $2.7 billion in the quarter alone. Here's the critical number. Approximately 96% of all lending is now funded through the company's own deposit base. That is a structural cost advantage that most fintech competitors simply do not have, because most of them are not chartered banks. They rely on wholesale funding markets or banking partners which are more expensive and less stable. The deposit base gives this firm cheaper funding, better margins, and greater control over its own economics. And the flywheel is working. Management calls it the financial services productivity loop. The idea is that more products attract more members generate more data, better data enables better underwriting, and better underwriting reduces risk while lowering customer acquisition costs. In the first quarter, roughly 43% of new product adoption came from existing members. That means nearly half of all new revenue is being generated at close to zero marginal acquisition cost. That's a powerful dynamic. Now here's the weak spot, and I'm not going to sugarcoat it. The technology platform segment, formerly known as Galileo and now being rebranded as SoFi Tech Solutions, reported net revenue of just $75 million, down 27% year over year. Contribution profit was $12 million at a 16% margin. The decline is primarily attributable to a large client that transitioned off the platform, which management had previously disclosed. But even with the advance warning, the market punished the stock for it. And analysts are right to watch this closely. Client concentration and churn in a B2B infrastructure business is a legitimate risk. However, what I think the market is underappreciating is the strategic pivot happening underneath the numbers. The rebranding from Galileo to SoFi Tech Solutions is not cosmetic. It signals a move up market from serving primarily small fintech startups to targeting tier 1 banks and major enterprise brands. Clients like Southwest Airlines and the US Treasury's Direct Express program are examples of this evolution. If the company can stabilize this segment and re-accelerate growth through new enterprise signings, it becomes a significant re-rating catalyst because this is pure capital-light recurring technology revenue, and the market assigns premium multiples to that kind of revenue. Let me now walk you through the balance sheet because for any financial institution, this is where the truth lives. Tangible book value reached $9.2 billion as of March 31st, or $7.21 per share, up 57% year over year. At the current stock price, shares are trading at roughly 2.1 times tangible book. For a high-growth digital bank, that's not unreasonable. Traditional banks typically trade between 1 and 1.5 times book, but the growth rate and margin trajectory here argue for a premium. Capital ratios are fortress level. The Common Equity Tier 1 ratio stands at 21.1%, well above the regulatory minimum. The Tier 1 leverage ratio is 17.7%. This firm is massively overcapitalized, which gives it enormous flexibility to absorb credit losses, fund growth organically, and deploy capital into new initiatives without needing to dilute shareholders. In a world where many fintechs are issuing equity to fund operations, self-funding through retained earnings and deposit growth is a meaningful competitive advantage. On credit quality, which is the single most important risk factor and the number one thing bears love to hammer, the data remains solid. The annualized net charge-off rate for personal loans was 4.4% or 3.03% when you include the effect of late-stage delinquent loan sales. The 90-day delinquency rate was 47 basis points, actually down 5 basis points from the prior quarter. The company maintains a 7 to 8% maximum cumulative net loss assumption, and actual performance from recent vintages originated between the fourth quarter of 2022 and the second quarter of 2025 shows cumulative losses of just 4.64%, tracking well below the conservative threshold. So credit is holding. But I want to be honest with you, this company has not been through a severe recession while operating at this scale. The borrower profile is strong, 745 FICO, 154K income, but in a deep downturn, even prime borrowers can see accelerated delinquencies. That uncertainty is real, and it's part of the discount the market is applying right now. Now let me tell you about the growth catalysts, because this is where the story gets genuinely exciting and where I think the market is underpricing the optionality. In December 2025, this firm launched something called SoFi USD, and it's a big deal. It is the first stablecoin issued by a US national bank on a public permissionless blockchain. That is a regulatory moat. While dozens of crypto-native companies have issued stablecoins, almost none have the credibility of a nationally chartered bank behind them. But the real play is not just the stablecoin itself. The company is building white-label stablecoin infrastructure, a stablecoin as a service platform that allows other banks, fintechs, and enterprises to issue their own stablecoins or integrate SoFi USD into their settlement flows. Originally launched on Ethereum, they're expanding to multi-chain support, including Solana for faster and cheaper settlement. And then in March came the MasterCard partnership. Let me emphasize what this means. The company struck a deal to integrate SoFi USD as a settlement option across MasterCard's global payments network. This is not a press release partnership. This is a structural integration that positions the stablecoin as a settlement rail for one of the world's largest payment processors. If this gains traction, the fee revenue potential is enormous. In April, they launched Big Business Banking, an enterprise platform that bridges fiat and crypto banking in a single nationally chartered environment. Companies can hold deposits, move money, and settle transactions 24/7, something most traditional banks still cannot do. The platform is backed by major digital asset infrastructure players including Cumberland, BitGo, Fireblocks, and Wintermute. This positions the firm as the institutional banking layer for the digital asset economy. And quietly underneath all of this is the capital light transition I mentioned earlier. Every quarter, the revenue mix is shifting further toward fee-based, capital light income, technology platform fees, origination and servicing fees, interchange, advisory. When the market sees that 40% or more of total revenue is recurring and capital light, the multiple will re-rate significantly. Let me now turn to institutional and insider activity because it tells you who's voting with their wallets. Institutional ownership sits between 55 and 80% depending on the source, with approximately 960 institutions holding over 820 million shares. The major holders are Vanguard, BlackRock, and several quantitative and event-driven funds. The institutional base is diversified and deep. On the insider front, CEO Anthony Noto has been consistently buying shares on the open market. Beyond the $500,000 purchase after the Muddy Waters report, he made additional buys totaling over $1.5 million in March and continued buying in May at prices around $16 per share. When a CEO is buying stock in the open market, not exercising options, not receiving grants, buying with his own money at the prevailing market price, that is one of the strongest signals you can get. There has been some selling from other executives, but it appears to be compensation related and typical for tax withholding on equity awards. Nothing abnormal. Short interest remains elevated at approximately 161 million shares, or roughly 13% of the public float, with a days to cover ratio of about 2 to 3 days. That's moderately high. It tells me there's a meaningful group of investors betting against the stock, but it also means that any sustained positive catalyst could trigger significant short covering and amplify upward price movement. So what is this company actually worth? Let's talk valuation, and let me be rigorous about it. At $15.48, the market capitalization is roughly $19.5 billion. Trailing PE is in the 32 to 36 times range. Forward PE is approximately 26 to 29 times. Now, if you comp this against traditional consumer finance names, it looks wildly expensive. Ali Financial trades at about 8 times forward earnings, Lending Club at 9 times. Even Upstart, which is a high-growth lending platform, trades at around 14 times. But those are the wrong comparisons. This is not a traditional lender. This is a chartered digital bank with a technology platform, a stablecoin infrastructure business, an enterprise banking product, and a 14.7 million member ecosystem growing at 35%. If you value it as a high-growth financial technology hybrid, which is increasingly what it's becoming, the premium narrows considerably. The company is growing revenue at 41%, expanding margins, generating GAAP profits, and has an estimated earnings per share compound annual growth rate of 38 to 42%. At 26 to 29 times forward earnings, that growth rate implies a PEG ratio barely above 1, which is reasonable for this quality of growth. Using a blended approach combining a discounted cash flow analysis with a 10% discount rate and 3% terminal growth, alongside a forward earnings multiple of 28 times on estimated 2027 earnings per share, I arrive at a fair value range of $19 to $22 per share. That implies 23 to 42% upside from current levels. The Wall Street consensus target of $18 to $23 is largely in line, which gives me additional confidence. However, and this is critical, the margin of safety at these levels is real but not excessive. This is not a stock trading at a massive discount to intrinsic value. It's trading at a moderate discount with meaningful upside if the catalysts play out, but with genuine downside risk if credit deteriorates or the technology platform continues to shrink. Now, before I give you my final verdict, let me lay out the risks clearly because every honest analysis must address what could go wrong. First, credit risk in a downturn. If we enter a severe recession and unemployment spikes among high-income professionals, charge-offs could increase materially beyond current assumptions. Second, technology platform instability. The loss of one major client already drove a 27% revenue decline. Additional churn without replacement would be damaging. Third, valuation compression. At 32 times trailing earnings, there is limited room for error. A single guidance miss could send shares down 20 to 30% in a day. Fourth, regulatory risk. The stablecoin and crypto banking initiatives operate in a rapidly evolving regulatory landscape. New legislation around stablecoin reserve requirements could alter the economics significantly. And fifth, competitive pressure. JP Morgan's Chase digital platform, Goldman's Marcus, and Apple's growing suite of financial products are all targeting the same affluent, digitally native customer base. So here's where I land on this. My bear case puts fair value at $11 to $13. That assumes credit deterioration, continued technology platform declines, and multiple compression to 18 times forward earnings. It would bring the stock back toward the 52-week low of $12.74. My base case is $19 to $22. Continued execution on lending and financial services, technology platform stabilization, and the market beginning to recognize the capital light transition. That's 23 to 42% upside from here. My bull case is $28 to $32. That assumes the MasterCard partnership gains real traction, big business banking scales rapidly, the tech segment re-accelerates, and the stock re-rates to a 35 times plus forward multiple. That would take it back toward the 52-week high. My rating is a moderate buy. The risk-reward at $15.48 is favorable but not asymmetric. I want to see two things before upgrading to a strong conviction buy. First, stabilization and ideally re-acceleration in the technology platform segment. And second, tangible revenue contribution from the stablecoin and enterprise banking initiatives. If both of those emerge in the second and third quarters, this stock has significant upside. For those already holding, stay the course. The thesis is intact and the operational execution has been exceptional. For prospective buyers, this is a reasonable entry point, but I would recommend dollar cost averaging into a position rather than deploying all at once. The macro environment remains highly uncertain, and this stock has demonstrated it can be extremely volatile in both directions. That's the full research, and as always, this is my personal analysis and not financial advice. Do your own due diligence. If you found value in this breakdown, make sure to subscribe and hit the notification bell so you don't miss future research reports. I publish institutional grade analysis every single week on the stocks that matter most. My original channel is not solved yet, so yeah, I will be doing videos here, so just make to subscribe, and that's all for now.